Hello, welcome to the Shipper Update. I'm lead economist here at FreightWaves, Anthony Smith, and I'm joined by the one and only Donnie Gilbert. And we're going to talk about not only business-to-business activity, because that just got updated just a few minutes ago, but we're also going to talk about the week ahead. So Donnie, first things first, we're going to look at business-to-business activity as it pertains to freight and transportation. And so starting it off, we have non-defense capital goods new orders, and alongside that, we have our very own flatbed outbound tender rejection index. So looking at it here, we have our flatbed outbound tender rejection index in the orange line, and in the blue line, we have non-defense capital goods new orders year over year, excluding aircraft. So this is a mouthful, Donnie. Looking at year over year change for non-defense capital goods new orders, excluding aircraft. So that long, drawn out index is essentially meaning we're taking all durable goods that businesses have purchased or made orders for, and we're excluding defense orders because those are usually typically large and can really kind of skew the numbers, exactly.
Same with aircraft. Since they don't cost $5 a piece.
Exactly.
They're 50 million.
Exactly. And so we're looking at that. That's essentially going to show us what business-to-business activity is looking like for these capital goods expenditures. And what we've seen in the latest month of release, as of just this morning, a 0.5% increase, which is substantially strong since there has been ongoing month-to-month growth. So even though we're seeing some slightly downward movement, it's still at double-digit levels.
Yeah, and compared to, it looks like last year, it's far above what we were, and we've seen this grow as outbound tender rejection rates for flatbed have picked up as well.
Exactly, and so when we're looking at this segment, one of the big things that pops out to me when we look at the overall report, I have it pulled up here, 14% for shipments on a year-over-year basis, 24.7% on a year-over-year basis for overall durable goods. So we're looking at over 20% year-over-year change for durable goods. That's telling us that there is tons of momentum upstream for these durable goods. That's all going to flow downstream once there's adequate labor, of course, adequate supply of commodities and equipment, and that can all go into this flatbed outbound tender rejection index, tightening up capacity as we move on throughout the year.
So this could keep these dips from dipping down if we got, essentially built up book of business for flatbed freight moving downstream that's currently locked up, so it will flow on through, and it could kind of curve some of these downward trends and keep it up and going.
Exactly, and so this is one of the reasons why looking at these orders coming in, looking at the backlogs that's happening right now, and we're going to talk about that, I think, either in this shipper update or maybe for the next if we have a little bit more time, and we're going to look at what's going on with backlogs, because backlogs building up, just like you said, could alleviate some of those dips if we have those commodities in place, if we have those workers also in place when we're looking at these manufacturers. So, but for shippers upstream, of course, I'm sure you've heard about the overall tightness within the market. If you haven't been able to put in those orders, of course, during peak season, you might be a little bit disappointed when it comes to expectations around December and the holiday season. So looking at upstream, nothing is different here. If you have those expectations for equipment or orders coming in, there's going to be slight delays, but momentum is still going on. The impressive thing here, Donnie, is that prices have continued to increase, not as rapidly as they have in the months past, but prices are going up on a month-to-month basis, and these manufacturers have not slowed down, have not eased one bit, or really been deterred through these price increases. They've continued to manufacture, they've continued to put these new orders in despite the increased pricing environment, and that's showing us that there is going to be continuous inflationary pressures. Maybe not at the same level as we've seen earlier on in the year, but those increase in prices are here to stay, and those consumers have not batted an eyelash just yet. I don't think we've seen the thick of it just yet, or we're going to have prolonged inflationary pressures for those consumers as these increased pricing pressures continue to move downstream.
Yeah, so what was the average for August was what, around 8%?
For
inflation. So we're expecting to see the same, if not a little bit higher, once we get the numbers in. We got to get into October before we get September here, so I'm a little bit ahead of myself.
Right.
So not good to hear, but when rates go up, of course, it's the consumers that pay for it.
Exactly. And so in our next chart here, we're going to transition into looking at what to expect in the week ahead, or what we're going to be looking for in the week ahead. So we have weekly initial jobs claims here, which comes out every Thursday morning. As Michael Vincent comes up on here, it's like Christmas to me every single week. I get to open up this report to see what has happened within employment over the most recent week. And so the unfortunate thing that we've seen with weekly initial jobs claims over the last 2 weeks is that we've had back-to-back rates of instances of increase. And so those increases also come after we saw that recent mandate presented by Biden on vaccines. And so for those that have private businesses with 100 or more employees, and also all, believe federal agencies as well, either have to be vaccinated or receive those weekly testing. So we can anticipate that there's going to be some upward pressure from that mandate that just got presented by Biden in the coming weeks. So I'm not going to expect a new pandemic low, but hopefully we'll see some moderating, some sideways movement.
Yeah, you got all the questions. I mean, you drive around, you see all these people that need help, need help, need help, need help. Why are unemployment numbers going up?
So this isn't going to be the unemployment number, but initial jobs claim. So unemployment rate is still low, still coming down, but we're still seeing that initial claims going up. I think one of the big things that we're also going to see is the right fit for adequate labor to the adequate employee. And so that's going to be a big one. Do people want to take some of those historically lower paying roles or service side roles, whether it be hospitality, whether it be within restaurants, things like that? We're definitely going to see some of those seasonal trends hopefully pick up as we look at holiday workers. Warehousing is going to be huge, especially for those manufacturers. Amazon is looking to get as many people into those workforces. As we talked about last week, getting rid of policies on marijuana and certain drug testings, just to say, okay, we want more people in. Let's lower the barrier here and get more folks at work.
We've seen this in the trucking industry a lot as well, where they had a minimum 1 year driving, which was dropped to minimum 6 months of driving experience. And now it's, hey, come work for us fresh out of school. You'll need to ride with a trainer for 4 to 6 weeks. So yes, we're seeing a lot of those barriers come down now just to try to bring in new employees and maintain where they're at, not even try to grow the companies.
Exactly. And as we know, retention rate's always a thing. Donnie, thanks so much for joining us for this shipper update.